The Federal Reserve keeping interest rates unchanged in its final meeting of the year. Powell reiterating several times at his news conference that the Fed still needs to see more evidence that inflation is moving down. Here to discuss what this means for investors, we have Steve Brown, Guggenheim Total Return Strategies CIO. All right, Steve, so we turn to you. What does this mean for investors? What was your response?
It was an unequivocally dovish meeting. It's been something that we've been looking for quite some time. Frankly, the Fed is doing what they said they were going to do, and that's rely on the data to decide when to pivot policy. And I think, Josh, you referenced it earlier. This is a pivot. And importantly, it's been removing the right-tailed distribution for interest rates, which has implications for risk assets, for bond markets, of course. But importantly, the more investors can take really significantly higher rates off the table, and even now maybe higher for longer off the table, that has meaningful implications for the rest of the credit markets.
Now, you said that it's justified by the data. Walk me through that for a moment, because we did just get data that showed that inflation was decelerating,
right,
but not maybe as much as the market was anticipating. So is the coast really clear here?
Not necessarily clear, but I think actually your correspondent elicited one of the most interesting responses from Jay Powell. And that he said that you don't have to be at 2% in order to start easing. And that's one of the things we've been talking about internally too, because if they were to leave policy rates static and inflation does continue moving lower, which it has been, then policy rate, the real rate, would be increasingly more and more restrictive. So they've opened up the path to easing while not quite being at target, because they're acknowledging that if they were to stay static, they would be getting more and more restrictive.
It's so interesting to me because one of the many knocks on the Fed has been that it tends to be behind the curve habitually.
Right.
So the fact that Jay Powell said that, does it say that we're in a different kind of Fed regime? Has the Fed learned its lesson on that front?
Well, history will answer that question. But I think what it's showing is the Fed is not on a one-track policy mind, and they are being more flexible. I mean, think about the responses that they've had to deal with over the last couple of years, even going back to March, where they had unorthodox responses to a mini banking crisis here in the US and around the globe. So they've really had to be flexible with their policy, not just think about the policy rate. One thing that didn't come up today was the balance sheet. The expectation, I guess, is that we would still continue to see that roll off in the background. So they're using the various tools that they have at their disposal, and I think they're showing that they're flexible and data dependent. So they really mean it when they're data dependent.
And Steve, what's Guggenheim's view of when those rate cuts could start next year?
So we were pretty early on thinking that the Fed would pivot. We've been thinking that they would lower rates upwards of 6 to 7 times, meaning 150 to 175 basis points next year. That's still our general belief, but it's conditional on how the economy goes. I think one of the things that the Fed's been worried about over the last, before the end of October, was how much tighter financial conditions we're getting. They weren't able to say that publicly, but when you saw interest rates go from 4% to 5% so quickly, I think it caused them to react. And importantly, the economy's slowing down. They're starting to see signs of a weaker labor market, which they want to a certain extent. They want it in the extent that it actually lowers inflation and wage inflation, but they don't really want a much higher unemployment rate. They would like to engineer what they're looking for, which is a soft landing.
And so, but if you're looking for 150 to 175 next year alone, and they're saying 75, that's a big gap.
Yeah.
Does it imply that we do get a soft landing and so that they feel like they can? Or does it imply there's a recession and they feel like they need to?
We're seeing a higher than normal risk of a recession, which would then be met with higher than expected rate cuts. If the Fed is able to engineer this softer landing, then we would expect a more measured approach to easing policy. So it's a highly conditional answer, but one that, importantly, and we're bond investors, it's been a tough couple of years for bonds in general. You have really elevated money market balances. You have investors who are looking to come back into bonds, but we're not at an all clear sign necessarily in the aggregate, but the confidence is there to get back into the asset class when you stop thinking about higher and higher interest rates.
And Steve, let me get you out of here on this then. In your universe, where are the opportunities that you see?
So we're a credit investor primarily. We specialize in structured credit and corporate credit. So we look outside of benchmarks and indices for unique opportunities. And fortunate for us, it's been an environment where we've had plenty of opportunities because spreads or the compensation in excess of, say, treasury yields that you're getting have been persistently wide. Some of that is from higher interest rate volatility, and some of it is just for structural reasons. So we feel like we're in a position to position portfolios that are defensive, but can also be opportunistic and generate significantly higher yields than we've seen in quite some time.
All right, Steve, thank you so much for stopping by today. That was great insight. Appreciate it.
Thank you for having me.